Good evening, everybody. Thanks for joining us. This week, I just wanted to take a look at the outlook for the US dollar. And we're starting by really approaching how I would look at markets after such a significant number as the US payrolls materialized last week. And this allows me to focus on the much more important and slightly longer term levels and see how this pans out. So basically, this is how I would approach analyzing markets at the early stages of the week after such a significant data release, and then just see how that pans out over the course of the coming week. Now, I want to do it this way because basically the US dollar is at a very, very important juncture at this stage technically. And I just want to take a look and highlight what I think are going to be the important levels for this week and really just sort of gauge if we start to see these points giving way, whether or not a more significant move begins to materialize. Now, I'm going to start by looking at a chart that you haven't seen before. This is basically something that I've developed to highlight the technical strength or weakness of each individual currency. And here we're looking at the US dollar. Now, basically, the way I calculate this is to look at all US dollar crosses within G10 and run a set number of technical indicators on those crosses and simply count up the number of positive, net them off against the number of negative, and that gives me a score that ranges between plus 18 and minus 18. Now, I smooth out any volatility within that score by using two moving averages, which are the blue and the red lines. Now, very basically, what actually happens is when we're starting to see the blue line, which is the shorter term average, cross above the red line, then that highlights an improving technical backdrop because we're starting to see a decrease in the number of negative technical indicators and an increase in the number of positive. So the blue line above the red line means that we're seeing an improving technical backdrop for the US dollar. However, as you can see, what most recently the movement has been declining moving averages of scores. And this reflects a deteriorating backdrop and the risk of underperformance beginning to develop. Now, if we look at the signals that develop within the US dollar index. Now, I'm using the Bloomberg index here because it's less weighted towards or skewed towards the euro and the implications of euro dollar and movements has on the normal DXY index. And we'll look at that in a second. But I just wanted to highlight the types of signals that we get by using the crosses within scores. So the green areas are where scores are rising, the moving averages are rising, and the red area is when they're declining. And you can see the most recent activity has seen a declining backdrop and the risk of underperformance developing within the US dollar in general on a relative terms against the rest of G10. So you can see that we see some reasonable signals beginning to develop. And most recently, obviously, that upturn in smooth scores has seen a very positive backdrop for the dollar, and that's entered into a corrective phase. Now, sorry, excuse me. This has taken us back to some very important levels technically when we look at some of the G10 crosses. And I think that this is what's going to be very important this week after the release of the payrolls data. Now, if we look at the DXY, the US dollar index, we can see why we're at such an important juncture for the dollar. Now, the greater influence, obviously, because of the weightings, is within euro dollar. But even so, we can see that the recent strength that's materialized within the daily chart as a reaction to the recent declines, and this is where we were seeing those declining scores and still are, we can see that the reaction has been held by 102.71, which is the 38% retracement level, having rallied from 101.34, which is the midpoint of the entire March 30th to May 13th advance. So technically, the US dollar has tested important support and important resistance over the last week or so. Now, the release of payrolls hasn't seen a breakout from this range develop, but certainly this is going to be quite an important break either to the up or to the downside that's going to trigger the more significant move. When we look at the daily chart together with Bollinger Bands, this also confirms that important resistance around the 102.74 area, because as we've discussed previously, while we're below a declining mid-average of Bollinger Bands, a more negative backdrop is in place. So again, this is an important resistance level. And if the dollar is to reverse this latest downside move, it's likely to be breaks of this and this retracement point that will trigger that type of fresh upside move. Without it, downside can develop again, and we could be looking at a more extended correction phase. And if we look at the weekly chart, the mid-average of the weekly Bollinger Band is as low as 99.47. The 38% retracement stands at 98.94 of the entire upside move from January 2021 lows. So again, if we start to break below that immediate support level that we've just highlighted, then the risk is for a deeper sell-off and a more extended correction beginning to materialize. And this would set and continue the declining scores that we're currently seeing. So the US dollar underperformance, the deteriorating technical backdrop, and the risk for a deeper sell-off. However, as we were looking at, we have failed at sort of daily resistance levels. And we would need to break above that to suggest that this is a limited correction and that we're not going to get back towards this area to resume what is still, and this is the important point, a longer-term bullish trending condition for the US dollar in general. So downside that we're currently seeing, even if it's extended, is still within the longer-term positive trending conditions. And when we look at something like the euro dollar on a monthly basis, we can see that that longer-term negative trend has continued to pan out, and we've broken lower from this symmetrical triangle type consolidation pattern. So again, this highlights longer-term negative themes beginning to develop for euro against the dollar, so dollar strength, from a longer-term perspective. But when we start to look at the weekly chart, again, we can highlight these important support and resistance levels that are going to be very critical for the coming week or slightly longer than that if we continue to hold around these levels. So that corresponding 38% retracement level of the latest recovery stands at 106.21. And that resistance, which held very well last week, is 107.91. So we might have hoped that we would see a trigger point begin to develop, having seen the release of payrolls. That didn't materialize, but it allows us to focus on these important levels this week and really gauge where the directional risks are beginning to materialize when and if we start to see a breakout. So 107.91 to the upside for euro dollar and 106.21 to the downside is going to be a very significant point. However, even if we do start to break this 38% retracement level, because of the longer-term bullish US dollar backdrop, that would seem to suggest a move towards the midpoint, which is at 109.25, and that could well be a much more significant long-term resistance area from which risks could skew towards failure and a resumption of what is still a longer-term bearish trending condition. So we know the levels to monitor, and we will react to when and if those breaks develop. But certainly if we start to see 106.21 give way, then that would suggest an earlier resumption of a longer-term bearish trend for euro dollar and the potential to retest the January 2017 lows at 103.44, which is the area from which we've rallied recently. And then tying that in with the monthly picture would hold significantly more significant longer-term bearish risks. So just to confirm those areas, we can see on the daily chart, the rally has held at this retracement point. The setback has been held by this first retracement point of strength. And I think for this week, it's really going to be a matter of monitoring these levels very closely. Now, the dollar strength, or perhaps what it should be phrased more, is yen weakness, has seen dollar yen breaking significantly higher. And we've broken this longer-term downtrend, and this still reflects the potential to initially test 135.14, which is the January 2002 failure high. And if that starts to give way back up towards these longer-term retracements and resistance levels up towards 147.33 to 61. So the longer term bullish dollar theme is still very evident within this chart. However, when we look at the weekly chart, last week's very strong advance within dollar yen, and that was helped by the activity within US 10-year yields, has been boosted, and potentially we're on course to retest this 131.33 failure high, which would leave this recent setback as just a correction from overextended upside conditions after this very strong advance, from which further support can develop and develop those longer-term US dollar themes. But again, this is also a factor of yen weakness. The yen is suffering significantly again, and I think the overall risk is for further downside pressure to develop there, and that can see potentially dollar yen pushing towards higher levels. The one slight exception coming into payrolls last week was sterling. And we've seen on the weekly chart here, last week was actually one of the few dollar crosses that actually put in a negative candle for sterling or positive candle for US dollar as the selling pressure started to develop. And the critical focus for this week, having seen the release of the latest data, is 124.72. That starts to give way. Risks are that this, what is still a longer-term bullish dollar trend, can be extended, and that can break and test the 62% level, even retest 121.70, which was the May low and rally point, and extend these more negative themes, which from a longer term viewpoint could possibly even see the March 2020 spike lows approached. But certainly the general backdrop is that if we start to see 124.72 giving way, then that can trigger a much more significant decline and a more extended phase of weakness. So I think, the summary really for the dollar at this stage is that it is a bit of a mixed bag. We are at very critical levels that we need to monitor this week to see how these areas are defended and whether or not we start to see more significant moves beginning to develop. So for me, the first focus would be smooth scores. If they continue to decline, then the chances are that we would expect and extend this negative phase that we have for the US dollar. But if they were to start to turn up, then that could highlight an increasing positive backdrop and the risk to break those levels that we've just discussed. These important levels need to be monitored, be it to the up and to the downside. And that's certainly what I'll be doing this week to see how this is likely to really pan out for coming weeks, because potentially breaks could reflect much more serious and longer term new technical signals to establish and extend longer term trends. So it's closing breaks of these levels that we need to see. And once they develop, then that is likely to highlight a more sustainable move and just give us the evidence of where the next phase of the US dollar bullish trend, if we start to break those important levels, begins to develop. But it's important to stress that even if we do see further US dollar weakness developing, that the long-term US dollar bull is still very much in place. And that if we do start to see that reasserting itself, then that can have significant implications for the longer term outlook for the US dollar and retesting those much more significant longer term support or resistance levels. So thanks very much for listening. I think it's going to be a very interesting fortnight for the US dollar. We know the levels to watch and see how that begins to pan out. Thanks very much, and I'll see you again in 2 weeks. Thank you.